Yo, what's up, everybody? It is Tuesday, January 30th. We had a beautiful stretch of weather here in Southern California. It was like almost 80 degrees for the past 3 days, but now we're going to get the atmospheric river. There's a lot of rain coming in. Anyway, mixed market today. Dow made a new record high. NASDAQ was down. We had some earnings after the bell. Microsoft, Alphabet, they all beat, but I think there was some issues there. So those stocks in the aftermarket were a little bit lower. A viewer asked me a question, which I thought was a good question, and I responded, but I just want to go over it. A viewer, because the other day I said that way before the Fed started to operate with negative income and negative equity, years before, I said there would come a time when that was going to happen. I predicted it. And I said it would happen if and when the Fed ever raised rates to 2.5%. I said 2.5% was the threshold where the Fed's income would be wiped out. And if they kept raising it after 2.5%, they'd go into a negative income, negative equity situation. And the viewer asked me, Mike, how did you know that? How did you come up with 2.5%? And the reason I came up with 2.5% was because up until that point, the Fed had been earning year after year 2.5% on its holdings. Because how did I know that? I knew that because the Fed was handing over $100 billion in profits annually to the Treasury. And it was making $100 billion in profits on $4 trillion in assets. It had $4 trillion in assets. So roughly it was earning 2.5% on $4 trillion, right? That's $100 billion. So I said, if and when the Fed eventually raises the rate to 2.5%, it would break even. In other words, it would have to pay out in interest on reserves all the money that it was earning on its portfolio. And if it went above 2.5%, it would be in a negative situation. And of course, we're at 5.5% now. So, it's way above. And I think the Fed's portfolio now is like 7 trillion something. All right, so it's paying 5.5%. So that's, was that 350 and another 30? It's like almost 400 billion annually. So if it's making, like 2.5% on that 7 trillion, let's call it 3%, so it's making 200 billion, but it's paying out 400 billion, it's losing like 200 billion annually. But I also said that would not stop the Fed from operating as normal. I mean, that just, the Fed can continue to credit bank accounts with reserves, and it doesn't affect the ability of the Fed to operate as normal. I just said that would be the threshold, 2.5%. Nobody was saying that. I said that years before it actually happened. And it's not like I'm some genius or something that calculated that, but it's logical. The Fed had was earning X amount on a certain quantity of assets. How did I know that? Because it was giving it to the Treasury every year. That was a reported figure. It wasn't like it was secret or anything. So you could deduce, the rate of return on its assets, and then just calculate if it had to pay out that equivalent, and that was like a 2.5% interest rate, it would end up losing all its income. So anyway, we have that. So now I have to say that first of all, January, we're in January, we're almost done with January. The federal budget balance for January, folks, we're actually in a surplus. It's a teeny tiny little surplus of 315 million, like quotations in the millions. When you're talking about central banks, they're really kind of irrelevant. You could almost say like it's a balanced budget, but still, it's a teeny tiny little surplus. All right, so we've been running like 160, 180 billion deficits. Now it's a tiny month of January is a tiny little surplus. What is happening right now is that the tax drain is basically removing the gross transfers to the economy, from government to the economy. In other words, leading fiscal flows are very, very high, okay? They're up 107 billion over last year. And last year we did, the government spent top line 7 trillion. And we're up 107 billion over that figure, Well, we're running on that at that baseline rate, okay? But the net, in other words, when taxes are removed from that, flat. Not even flat, now down a little bit. So, to me, this is problematic. I mean, it's great that these leading flows are very strong, but if they're kind of immediately sucked away, it doesn't leave any balance really, or any additional balance for the non-government sector, the economy. And it's a problem for me with respect to the stock market, which has been making new highs. Again, the Dow today made an all-time new record high. It's a problem to me because you need those transfers. When you start to remove those transfers, basically what you're saying, if you use the swimming pool analogy, that water's going down, okay? That level is going down. It's not even really staying even anymore. That would be one thing if it stayed even. It's starting to go down. Now, it's not really, sucking down very, very rapidly. It's going down slowly, but nevertheless, it's going down. And that's a problem for me. Now, we have coming up in February 15th is going to be a quarterly interest payment, all right? And that's going to be the peak in the flows, February 15th, because after that, we get into March. That's a tax drain. You have a quarterly corporate tax drain. Then the biggie comes in April when you got the, individual income tax filings are due and payments and stuff like that. So you have 2 months, March, April. Now, what could at least temporarily rescue us from that negative impact? So we got 3 things that are negative right now. We got that the deficit is shrinking slowly. We got the March tax drain coming up. We got the April tax drain coming up. On the positive side, we have a February 15th quarterly interest payment, but that's going to be the peak in these leading flows until May. But what I'm saying is, what could rescue us from the negative, the clouds are building on the horizon. We're out there in our sailboat on the open ocean, and we see the storm coming together in the distance, all right? And we know we're headed right into it. But there's a ray of hope, and that would be if the Fed cuts rates in March. Right now, there's only a 56%, right now there's only like a 43% probability that we're going to see a rate cut in March, at least based on how Fed fund futures are trading. Okay, a month ago, that probability was 73%. Okay, a month ago, it was almost a sure bet in the market that we would see the first rate cut in March at the Fed meeting in March. Now it's down to like 43%. It's 57% that there will be no rate cut. We got a Fed meeting coming up. Well, I guess it will end up tomorrow at 2 p.m. We'll get the Fed statement. The meeting is ongoing currently. We'll get what the Fed says, and the monetarists are going to be hanging on every word in that statement. Okay, as usual. And to me, when I look at these numbers, the probabilities in the market, it looks like where can there be the bigger surprise? Would there be a surprise if the Fed came out on the hawkish side saying, well, where the rate cuts are still a long way off? Or will there be a bigger surprise if they say, yeah, we think we could do a rate cut sooner rather than later? I think it'll be with the latter. In other words, if they say we're going to do it sooner rather than later, if they're leaning in that direction, then you're going to see the market pop. And the reason why I say that's where the surprise can come in is because the market is not expecting a sooner rather than later rate cut. And I've always said, like, if the market was a living thing, if the market was a person, its job would be to fool as many people as possible. So right now, people are thinking, oh, there's not going to be a rate cut in March. So I think to fool as many people as possible would be tomorrow we get a pop higher in the market. Now, I'm not, I've said this before, and I want to go over this again because I think this is a very important point that I'm making. And it was basically the same point that I made when the Fed started to raise interest rates. And I told everybody here, I said, ultimately, that's going to be a bullish thing because that's going to equate to much higher interest income transfers into the economy. I said that's a fiscal operation. It's going to raise the fiscal support, and it's going to be bullish for the economy. It's going to be bullish for the stock market. I was the only one who had that outlook. Everybody else was like doom and gloom, and this is the end, and there's going to be a crash, and there's going to be a recession, 100% guaranteed recession. I said, not going to happen. So now what I'm saying is that if and when the Fed starts to cut interest rates, yes, we will see initially that reflex monetarist zombie buying, panic buying in the market. And even now, I'm questioning, I'm wondering how much of that buying has already occurred in kind of a front running, the market's at all-time record highs. How much of that buying is already kind of like baked into the market because people are expecting this. But we will get a pop. But it's the same dynamic as the rate increases, only the inverse. So when the Fed starts to cut rates, what happens? That removes interest income from the economy. That slows down economic growth. That slows down or reverses corporate profit growth. That increases unemployment. Okay? You have the opposite effect. So I'm telling you, a lot of times, many times I've done these videos, and I say to you guys, we're going to come back and revisit my statements in, 6 months, 9 months, a year, and see how it played out. I said to you, I'm going to show you that what I'm telling you right now is going to play out exactly as I'm telling you. Like, people don't realize it at the moment. They don't realize it in the instant. They're operating on this false understanding, this kind of mythology, reflexively, without thinking about it. And again, I've done many videos about how even after it doesn't work out to their forecast, they never go back and try to analyze why it didn't work out. They just keep running with the same mythology. But I'm telling you guys right now, we will, if the Fed starts to cut rates, we will be revisiting this topic and this discussion I'm having with you, and how I'm telling you now how that's going to play out. And it's not, I'm telling you right now, it's not going to play out the way people think. The rate cuts are not going to be super bullish for the economy. And that means they're not going to be super bullish for the stock market. And they're not going to be super bullish for like job growth and all these things that are, economically dependent. Now, nobody's telling you that right now except for me. And we will come back and revisit that. So, that's the update for today. Tomorrow, expect a lot of volatility. I do expect the market to fool people tomorrow. So that would mean a pop higher in stocks. But I'm looking over that period from mid-February on as probably, depending on what the Fed does in March with respect to if it cuts rates, but we will see probably after that some kind of an important market peak. But let's see how it plays out. Anyway, that's it for today. Don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. See you tomorrow. Bye.